This series adapts a framework from Scott Galloway, professor of marketing at NYU Stern, from his 2024 book, The Algebra of Wealth. Galloway calls it FSTD: focus, stoicism, time, diversification. Today we are taking the focus pillar, and we are stress testing it against 40 years of investor data, real cases the book does not cover, and the cost of living math most U.S. authors miss. Here's a number that should change how you think about money. Until your investable assets cross roughly $250,000, the rate at which you earn matters more than the rate at which the market returns. A lot more. We did the math. A 28-year-old earning $60,000 and saving 15% will reach financial independence later than a 28-year-old earning $90,000 and saving the same 15%. By a decade. Same market. Same index funds. The only thing that changed was the size of the income shovel. Most investing content has this backwards. It obsesses over the 0.5% expense ratio and ignores the $30,000 raise. The expense ratio matters eventually. The raise matters now. Scott Galloway, professor of marketing at NYU Stern, calls this pillar focus. We are calling our version the earn equation, because it has 3 levers anyone can audit on themselves this week. Skill. What you are actually paid for. Distance. How far you can scale that skill before age and burnout limit you. And career compounding. The part of your earning curve almost nobody plans for. 3 levers. One number that decides which of them matters most. $250,000. Let me walk you through the math, because the gap is bigger than it looks. Take saver A. Earns $60,000 a year. Saves 15%. So $9,000 a year goes into a low-cost broad market index fund. Assume an 8% average annual return. That is roughly the long-run real return of the U.S. stock market over the last 100 years. The number Vanguard's century-long study lands on. The number we used in the Buffett $1 million wager. At $9,000 a year, 8% compounding, saver A reaches a $1 million portfolio in roughly 28 years. Now saver B earns $90,000, saves the exact same 15%. That is $13,500 a year going in. Same return, same fund. Saver B hits $1 million in roughly 23 years. Not 28, 23. A 5-year head start on the first million. And once you stretch out to true financial independence, 25 times your annual spending, the gap widens to about 13 years. Same discipline. Same market. The shovel is the variable. So before we talk about which fund to pick, we have to talk about the shovel. That is what Galloway means by focus, and what we mean by the earn equation. Quick pause. Save this video. Right now. Tap the save button or add it to a watch later list. Save it for the moment you are stuck on whether to learn investing or earn more. The order matters. Most channels will tell you to optimize your portfolio first. We are telling you, until you cross that threshold, the income shovel is the most important investment account you have. Saving this video means you can find it the day you need it. Now back to the math. Lever 1. Skill. And here is where most people make their first mistake. Skill is not what you studied. Skill is what the market actually pays for. The Bureau of Labor Statistics tracks wages across roughly 800 occupations in the U.S. economy. 2 graduates from the same university, same major, same GPA, can have lifetime earnings that diverge by a factor of 3 or 4. Not because one is smarter. Because one of them, somewhere in their first 5 to 10 years of work, identified a skill the market was paying a premium for, and stacked the next 3 skills on top of it. John Bogle proved this in the other direction. He showed that a 1% fee, compounded over 30 years, eats roughly a third of your final portfolio balance. We covered that math in the Buffett $1 million wager. Income works the same way in reverse. A skill premium of $15,000, $20,000, $30,000 a year, compounded across a 40-year career, is the difference between two retirements. And there is a body of Stanford and Harvard Business Review research that adds another 7 to 10% to lifetime earnings just from one habit. Negotiating salary. Asking. We unpacked that in detail before, on salary negotiation. Most people do not ask. They take the first offer. And they leave 7 to 10% on the table every time. Lever 2. Distance. This is the question almost nobody asks before they pick a career. How far does this skill scale before age, fatigue, or saturation puts a ceiling on it? Take 3 classic curves, drawn from BLS occupational data and LinkedIn salary research. The early career software engineer starts around $80,000 in a major U.S. city. By year 10, the median is around $170,000. By year 20, the curve flattens. The lawyer starts higher. By year 15, partners can clear $400,000 and up. The curve is steep. The hours are brutal. The surgeon, slowest start. A decade of training before the first real paycheck. Then a long, almost flat plateau at $600,000, and up that runs for 25 or 30 years. 3 skills. 3 completely different shapes. The shape of the curve matters more than the height of the peak. Because the question is not, what is the maximum I can earn? It is, how many years can I spend at the top of the curve before something else takes over? That is distance. The patience principle from the 1% discipline holds here. But only if you have something to be patient with. Pick the curve before you pick the title. Quick pause for the question that decides this week. What is your single highest leverage income move this year? Not the dream job. Not the side hustle that might pay off in 5 years. The single move you can make in the next 12 months. Drop 1 sentence in the comments. I read every one. And the answers from this audience are usually sharper than the videos. Now lever 3. Lever 3. Career compounding. The lever almost nobody plans for, because the math is invisible until late. Warren Buffett earned roughly 99% of his net worth after the age of 50. Read that again. 99%. After 50. The first 50 years built the platform. The next 30 multiplied it. The same shape applies to careers, which is the part Galloway flags directly in his book. Most income curves are not linear. They are exponential. The first 10 years of working life, your 20s, are usually the worst dollar per hour years you will ever have. The compounding happens because each skill, each network, each reputational data point, builds on the previous one. The 35-year-old engineer in an executive role earns more than the 25-year-old engineer, not because the work is twice as hard. Because 10 years of compounded skill, judgment, and reputation are sitting under it. Munger filtered investments through the 3-bucket system from Munger's framework. Yes, no, too hard. Galloway is asking you to filter career bets through the same lens. Most career moves should fail this test. The few that pass are the ones that compound for 30 years instead of 3. Now here is the part Galloway's book does not cover. Galloway's book is dollar-anchored and US coded. The $250,000 threshold is a local number, not a global one. We pulled cost of living data from Numio and the Economist Intelligence Unit's 2025 Worldwide Cost of Living Survey, and converted Galloway's threshold to local equivalent purchasing power across 8 major cities. New York City. about $250,000. The Anchor, London, about $220,000. Singapore, about $160,000. Berlin, about $140,000. Tokyo, about $130,000. Seoul, about $95,000. Bangkok, about $80,000. Mexico City, about $70,000. Same threshold. Same arithmetic. Wildly different absolute numbers. Now layer in remote work. The lever Galloway only mentions briefly is geographic arbitrage. Earn at New York or London rates. Live at Lisbon or Bangkok or Mexico City rates. The shovel gets bigger and the cost of living gets smaller, simultaneously. That is not a hack. That is a structural advantage that the last 5 years of remote work normalized. The lever is not, move to Bangkok. The lever is, recognize that the threshold is local. Once you do, the math of when income beats the market rate stops being one number. It becomes a range. So here is the earn equation in one frame. 3 levers. Skill. What the market actually pays for, separate from what you studied. Distance. How far the curve runs before age, fatigue, or saturation puts a ceiling on it. Career compounding. The late career multiplier that Buffett's 99% after 50 number quietly proves. And one threshold. $250,000 in investable assets. Or the local equivalent for the city you live in. Below that line, the income shovel is the dominant variable. Above it, the market starts doing the heavy lifting. That is Galloway's focus pillar, translated into something you can audit on yourself this week. Here is what to do this week. Pick one of the 3 levers. Just one. Skill. Write down, in 2 sentences, what the market actually pays you for, separate from your job title. Distance. Sketch the next 10 years of your earning curve and ask honestly where it flattens. Career compounding. Name the one decision in the next 12 months that, if it goes right, sets up the next 10 years. One lever, one sentence, one decision. The earn equation does not work in theory. It works on the page. One quick thing before we close. If this was useful, hit like and subscribe so the rest of the algebra series lands in your feed. Coming up next, the compound engine. How $500 a month becomes $1.6 million. See you there. The framework is Galloway's. The math, the cases, and the global perspective are ours. Build wealth with patience, not panic. Calm investors.